Someone who looks at markets with a slightly longer term view. Anant Shirgaonkar, the head India Equities at UBS Securities, joins us now. Anant, good morning. Thank you very much for joining us. What's the view at UBS? Is it that we are in for something very bad in terms of global growth, and a year, maybe a year from now, or even a quarter from now, all equity markets will be trading at lower levels?
No, so I think on the global front, our view is that we will remain in the modeling mode. What we mean by that is China still remains a concern, although on the regulatory front, on the government front, we are seeing measures by the Chinese government, as we saw yesterday, in terms of the RRR cut and the bank rate cut that we saw. What is a clear indication is that the Chinese government wants to send out feelers to the market that it would take all measures to ensure that there's financial stability. Beyond that, we're still looking at the Fed rate hike in September. That still remains our base case. But given that the macro data points seem to be weakening, we would have to see about the pace of rate hikes beyond that. But for now, I think we're still looking at a rate hike in September.
Okay. Anant, hi, morning. So since there's so much uncertainty globally, would you advise that retail investors or long-term investors raise their cash positions, or do you think that this is still a good time to be looking at individual stocks?
No, I think anybody who's investing in the Indian equities now needs to keep the broader picture in mind. And one of the things that we've been highlighting for some time now is the disconnect between the consensus earnings expectations in India versus what can actually be delivered by the markets. For example, in the quarter just went by, we saw the top line of Nifty companies down by 5%, and the bottom line was down by 2%. Now, the street expectations for the full year still remain pretty high at about 15 to 17%, which means that in the remaining 3 quarters, we would have to produce 23% earnings growth to meet the street expectations. Our expectations are at about 10% growth. So we will have to see over the next few quarters the street earnings expectations come down from this 15-17% to about 10-ish%. We've seen in the past that whenever the market goes through an earnings downgrade cycle, typically it struggles to do extremely well. So I think we will have to muddle through the next 2 quarters till we see this adjustment go by. Anybody who's got a view of 12 to 18 months should take advantage of this correction which might play through and have a longer term view to benefit from the Indian equities.
I understand you'll have a Nifty target of 8,600. Is that for 2015?
Yeah, so our target still remains 8,600, which is about 10% upside, because inherently we're still positive on India as a market and Indian economy. We still feel that Indian economy would grow among the fastest growing economies in the major emerging markets that we've seen. Plus, the fundamentals in the economy still seem to be pretty robust in terms of inflation coming down, in terms of the possibility that RBI incrementally would at some point in time start reducing their rates. So the backdrop for the Indian economy and Indian market still remains pretty strong, but we will have to endure the correction over the next 2 quarters, especially in terms of the earnings downgrades.
Okay. You are overweight on the oil and gas space, and you have a couple of picks over there. What do you think could be the triggers from here on to invest into some of the large cap oil and gas names? Because overnight we did see some delivery based buying in names like Reliance Industries.
So see, a couple of things. On the oil and gas space, we are still particularly bullish on the oil PSUs. Simply because I think the government has done its bit in terms of deregulation. So petrol is deregulated. We've always completed the diesel deregulation. So all that seems to be on track, and the subsidy, thankfully, because of the crude coming off, has come off to much lower levels than what we had earlier expected. So oil PSUs certainly seem to have the tailwind behind them, and we are bullish on them. On the private names, I think some of these conglomerate names we would be positive on, simply because the stocks have underperformed over the last so many years, and there's been a massive consolidation. Stocks have also become cheap, partially because of the crude correcting so sharply. So I think the risk reward really seems attractive from here in the oil and gas space.
Okay, well, Anant, Would it be a good idea now to get into the dollar earning guys simply because the rupee appears to be at long last appreciating?
You see, on the currency plays, I think we look at currency only as a short-term tailwind or a headwind. I think the way we are looking at, say, an IT or pharma is essentially how the sector fundamentals would play out. And on IT in particular, we have an anti-consensus negative bias on the sector, primarily because we think that the demand is going to slow down for the IT sector, and there is a bit of disruption in the IT space in terms of digitalization that is playing out, in terms of new models which are emerging, and in terms of automation which is going to reduce the space for outsourcing. So on these counts, we remain sort of negative on the IT space. On pharma, I think the US FDA approvals seem to be accelerating. So we think that the prospects for pharma are definitely brighter over the next 2 years. So on the dollar plays per se, I don't think the calls are based on what the currency is going to do, but rather how the fundamentals for each of these sectors is playing out.
I was just going through some of your mid-cap bets, and within that you have names like Britannia, LIC Housing Finance and SKS Microfinance. These are great companies, good businesses, but the stocks have run up quite a bit. In a market like this, where the upside seems to be capped for the near term, you think it still makes sense to buy some of these stocks?
You see, I think we wouldn't go into stock specifics, but on valuations, I would agree with you. On the small and mid-cap space, we aren't really as bullish as we were, say, a few quarters ago, because the stocks have run up, the valuations are no longer cheap. So we are sort of equal weight or neutral on the small and mid-cap space. Within that, I think there are still areas wherein we can find value. Maybe the housing finance space, maybe particularly premiumization in terms of consumption. So these are the themes that we still like over there. Plus, if you have a slightly longer term view, we are positive on the cyclical recovery with a 2 to 3 year view, and therefore any of those plays which qualify as cyclical recovery plays, we should be able to keep on accumulating now, and hopefully they'll do well as the cycle plays out with a 2 to 3 year view.
So you're saying that one should stick to the domestic consumption stories, names like, some of these four-wheeler names, some of these FMCG names, and they will give you better returns compared to the export-led companies?
No, so we are again very counter consensus view on domestic consumption. So we are sort of negative on consumer staples and negative on the two-wheeler names that we see. So basically on the two-wheeler space, we think that the pent-up demand in the system isn't as high as we see in the four-wheeler names. So I think we're positive on the four-wheeler names in India, really negative on the two-wheelers. On consumption, I think we on a broader base, we're still negative on consumption. One, because we believe that rural consumption is going to be adversely affected. One, because of agriculture incomes sort of getting affected. And secondly, the rural stimulus which the government had shown in the previous 5 years seems to be sort of waning, in addition to the MSP prices being muted. So net-net, rural consumption would be a drag on overall consumption themes, and therefore we believe that anything to do with, say, premiumization or urban consumption may be slightly better off, but we need to keep a watch on valuations on that front.
Okay, by the way, just take a look at the market. It has recovered from the lows of trade. In fact, the mid-cap index is now in the green. So the index itself is up about 0.1%, and the Nifty is making an attempt to recover, led by some of these large cap names. So take a look at ONGC. It's up 1.5%. Kotak Mahindra Bank is up 1%. So are many of these auto names like M&M, Bajaj Auto are all in the green, and Reliance once again is up almost about 0.5%. So there is some momentum that's returning back into the market. It is a very volatile market, of course, but the Nifty has picked up from the low point of trade. Finally then, Anant, in terms of, another preferred space for you is telecom. Before we saw the market crash, the telecom stocks like Bharti actually had a good run. Is there more steam left in that space, and is it just the frontliners, or would you look at some of the other names as well?
No, so on telecom, we are positive on telecom service providers as well as the tower plays. So what we see over there is, one, that the pricing could have bottomed out. We're seeing that freebies in the pricing front seem to be getting withdrawn from both 2 or 3 of the large telecom companies, and therefore quarter after quarter the margins have been improving for the last 8 or 10 quarters. Plus we've seen that the data consumption is growing very strong. Our projection is that data would actually grow 10 times in the next 10 years, and therefore that would provide an additional tailwind for the telecom names. So overall very positive on telecom space.
Okay, just a final question, Anant. What are your global guys and strategists and economists telling you? Are we in for some nasty time in the next quarter, a serious breakdown in terms of appetite for risk as well as economic slowdown?
No, so that is not the base case that we have. What we are seeing is that the markets had run up quite a bit, and we've seen some correction that is played out. If you look at the valuations over a longer term period, we've seen that for price to equity or price to book, for emerging markets or Asia Pac, we've started to see some of those measures dip below the 1 standard deviation lower than the longer term averages. So we're seeing some kind of capitulations or signs of capitulation, especially on the equity side. We're not seeing enough of that on the currency or the fixed income side. So I think what's playing out is that the valuation, which had run up quite a bit, have sort of given up in some pockets. They haven't really given up in some pockets, but I think that is the correction that we've seen so far. The second thing that's playing out is the emerging market flows seem to be reversing. We've seen about $38 billion go out YTD, which compares to about $39 billion in 2008, which is quite a stark comparison. We believe that on the equity side, quite a bit of that could be behind us, and therefore our view is on the equity side, we've seen enough signs of capitulation, and at the margin we should start looking at emerging market equities constructively. Within that and within Asia Pacific, we are positive on India as an economy and as a market.
Right, that's a very hopeful voice and an optimistic interpretation. Anant, thank you very much for joining us with your thoughts today. Well, we need to take a quick break. We leave the markets once again rather deeply in the red, 0.5% gone again. So really the tops are not holding, at least as of now. Back in a minute with a global market expert, actually. Jamie Fahy of Citi is joining us.